Hi, I'm Jonathan Weininger, Director of Audit Services with the State Board of Accounts, and I've prepared this presentation to assist with properly reporting the capital assets and accumulated depreciation in the annual financial report. These requirements are effective for schools for the period ending June 30th of 2021 and for other governmental units for the period ending December 31st, 2021. Each unit of government should have already established a capital asset policy. The capital asset policy is required to detail the capitalization threshold. This is the dollar amount that the governing body has set that requires the governmental unit to capitalize the assets and to maintain record on the capital asset ledger General Form 369. The capitalization threshold is a management decision and will not be the same amount for every unit. I also want to take a moment to just note that just because an item purchased falls under the capitalization threshold, it doesn't mean that there doesn't need to be a tracking of those items as well. Those purchases just aren't required to be accounted for on the capital asset ledger. The next few slides, I'm going to cover items that are not required to be part of the capital asset policy, but I recommend considering these items and incorporating them into the policy. Who is responsible for maintaining the capital asset ledger? What procedures and internal controls are being implemented to ensure the person responsible for maintaining those capital assets is receiving all information needed to properly maintain the capital asset ledger? What is the useful life of the assets? The estimated useful life is how many years do you expect the capital asset to be in use? Set a minimum useful life by category, be consistent, and make sure it's reasonable. What is the policy for accounting for depreciation in the year the asset was purchased? Is a full year of depreciation being accounted for in the year the asset was purchased? Is depreciation being prorated? An example, if the asset was purchased in March, is 9 months of depreciation being taken, or is it going to be the policy to not depreciate in the first year of purchase at all? Just depreciation should be treated consistently. The State Board of Accounts has prescribed General Form 369 Capital Asset Ledger to maintain record of the capital assets. This form may be electronically duplicated or may utilize another form, but this is key. The function and the information that is required on the prescribed form must be maintained. Here's a sample of the General Form 369 Capital Asset Ledger that is to be used to account for the assets uh, over the capitalization threshold established by the governing board. I'm going to briefly discuss each column on the form. So the first column is the date of purchase. This is the date the capital asset was paid for or possession of the asset was received. Then you have description of asset. Be detailed in the description. A couple of examples, instead of just recording school bus, record 2019 72 passenger school bus. Or instead of fire truck, record as 2019 water tanker. The more descriptive you can be, the easier it'll be to determine exactly what asset is listed. The serial number, this may not always be a serial number. It could be a vehicle number, such as the VIN number for vehicles. It just needs to be a number that specifically identifies the capital asset. Location of the asset, where is the asset being housed or where is it located? The original cost of the asset, this would be its historical cost. And the cost of the capital asset should include the capitalized interest, freight, transportation costs, and professional fees. Donated assets should be reported at their estimated value at the time of acquisition. Then we've got estimated life of the asset. We discussed this on an earlier slide. This is how many years do you expect the capital asset to be in use? The date of disposal of capital asset. This would be the date the asset was traded or sold. the amount received on disposal or trade-in. This is the cash received when sold or the credit amount received on a trade-in. And then types of capital assets. Here you will enter the historical cost of the asset in the appropriate type of capital asset. And then the last column is the total capital assets. This should be a running total of all of the capital assets. The information maintained on this form will also assist in calculating accumulated depreciation, which I'm going to discuss on the next slide. So depreciation is an accounting method of allocating the cost of a tangible or physical asset such as buildings, equipment, and infrastructure over the life of the asset. So depreciation represents how much of an asset's value has been used up. For reporting purposes, capital assets has been split into two types of capital assets. We have depreciable assets and non-depreciable assets. Depreciable assets include buildings, improvements other than buildings, and machinery, equipment, and vehicles. Non-depreciable assets are land and construction in progress. Land is assumed to have an unlimited useful life, and construction in progress is where work has not been completed in the current reported fiscal year. And so with construction in progress, the asset hasn't been placed into service yet, so therefore it isn't depreciated. This is a formula to calculate depreciation. So to calculate the amount of yearly depreciation, you will divide the historical cost of the asset by the estimated useful life. This will give you the yearly amount of depreciation. And then accumulated depreciation is the total depreciation to date. On the next slide, I'm going to provide an example. So for example, a school bus was purchased in July of 2015 for $100,000, and the estimated useful life is 20 years. In this sample, it's the unit's policy to take a full year of depreciation in the year the asset was purchased. So to determine the annual depreciation, you would divide the historical cost of the asset, which is 100,000, by the estimated useful life of 20 years, and that's going to give you the yearly amount of depreciation, which would be $5,000. So it was purchased in July of 2015. So by the end of June 30th of 2021, the school bus would be in use for 6 years. So you would multiply the number of years that the asset's been in use by the yearly amount of depreciation of $5,000. And here I've calculated that to show that $30,000 would be the accumulated depreciation on the school bus at the end of June 30th of 2021. In making these calculations, the unit must maintain a documented basis for both the asset valuation, which is the support for the historical cost that's reported on the capital asset ledger, and then maintain a policy on the estimated useful lives, and then also maintain documentation for your calculated yearly depreciation and your annual and your accumulated depreciation. Next, I'm going to show what the capital asset schedule will look like in the annual financial report. This schedule should look very familiar. The only change is that the capital asset schedule is now split between non-depreciable assets and depreciable assets. Please make sure that there's a dollar value in every cell, even if there was no activity. For example, a governmental unit may not have purchased or sold land in the fiscal period, but a zero would still be required to be entered for additions and reductions. So the first part of this slide is the depreciable asset schedule, which, like I said, should look familiar as it is what the schedule looked like last year, except that the non-depreciable assets are split out. And then the second schedule on this slide is what the accumulated depreciation schedule will look like. The accumulated depreciation is reported at the summary level by capital asset type. So let's go back to the school bus example. The total accumulated depreciation for the school bus was $30,000, but $5,000 was the current year amount of yearly depreciation. So if a governmental unit only had this one piece of equipment, beginning balance as of July of 2021 would be $25,000. That was the accumulated depreciation up to the point of the beginning of this fiscal period. And then additions would be the current yearly amount of depreciation, which in this example would be $5,000. Reductions would be used when a capital asset is disposed of. The amount of accumulated depreciation would need to be taken off of the asset, and that would be included in the reductions to accumulated depreciation when you dispose of that asset. This is an example of what the capital asset note will look like in the enhanced regulatory report. There will be a schedule reporting the beginning balances, additions, reductions, and ending balances of non-depreciable assets. A schedule reporting the beginning balances, additions, reductions, and ending balances of depreciable assets. A schedule reporting the beginning balances, additions, reductions, and ending balances of accumulated depreciation. And then there will be a final line that reports the net capital assets being depreciated, which is the historical cost of depreciable assets less the total accumulated depreciation. So as you're going through this process and entering the information into Gateway, do not hesitate to reach out to any of the directors for assistance. I hope that you find this training beneficial as you are preparing this information. Thank you.